So basically, my career started, I was at Coopers and Lybrand, many years ago, and then it was PwC. Then I left, and I was managing director of taxation and legal affairs for a local telecom here. Then I ran helped run the New York City of an office regional CPA firm. And then I went out on my own, I guess, in 2012 now, so 8 years. I've been on my own. 24 years I've been doing this for. And I help companies of all sizes with tax and legal matters, as Kenya had said. So why are we here? What are we talking about? Why does choice of entity matter? First and foremost is asset protection. You're owning a business because you want to work for yourself and you want to protect your own personal assets. Secondarily, almost equally as important, but not quite as important as asset protection, is tax considerations. That is tax return filing considerations. And we're going to touch on some law changes in 2018. You're probably all well versed in it now, but I'm still surprised not everyone knows about them. Then we're going to talk about ownership considerations, growth considerations, and conversion considerations. Those things are all really why choice of entity matters. Okay? As everyone may or may not know, these are the types of entity choices you have. C corporation, which is generally publicly traded entities, Apple, Google, IBM, and things like that. S corporation, which I'm an S corporation, that's a subset of a C corporation. That's a pass-through entity, which means the entity itself is generally not taxed, and that income then passes up to you as an individual. If you think of it visually, pass-through entity means the entity is here and you're above it, and the income moves up to you and gets taxed on your personal tax return. Partnership, again, is another pass-through entity, and that's general partnership, GP, LP, limited partnership, or LLP, limited liability partnership. And LLCs, which most people here know what those are because they're advertised in the radio and everyone talks about them. That's a limited liability company, not a limited liability corporation, which is important. And then a subset of that is a single member LLC, which is also a pass-through entity. A single member LLC means only one person owns it. Generally, LLCs, multi-member LLCs, means many people own it. And that's important from a tax perspective. Okay? So basically, the legal formation of an entity and how it's taxed can be different. And it often does differ. Okay? You can form an entity in one way for legal purposes, but treat it differently for tax purposes. And this is, in one way or another, some people call it check the box rules. Okay? And basically, when you choose an entity type for tax purposes, you have to stick with that for 5 years. Does this make sense to everybody so far? Yes? Okay. So let's go with the most basic of all of them. And it's basic because everyone kind of knows what they are. It's the most straightforward. But things that everyone knows about are C corporations. Okay. And the reason you form a C corporation is it protects you. It's its own, protects you as the owner from basically anybody getting to your personal assets. And basically what a C corporation does is that's its own legal entity in and of itself, and it pays its own taxes. As anyone may or may not be aware, regarding due to politics, tax cuts came in a few years ago that reduced the corporate tax rate. And this is what this was. Tax rate was 35% generally for corporations, and now it's down to 21%. Okay? This provides the strongest asset protections due to how long the entity itself has been in existence. Hundreds of years old, C corporations have been around for. Meanwhile, the choice that everyone thinks is the right answer is the LLC, and that's only been around literally for a few decades. And case law favors asset protections for corporations. So basically, if you were to form a C corporation today, you made $100,000 and you moved that $100,000 either through a dividend or a salary to yourself, and then the C corporation got sued, it'd be very hard for the person who was suing the C corporation to get to your personal assets. That's what I mean by asset protection. You own a business, you want out of freedom, you want to get money out of the entity, and you don't want anybody to get to that money. And that's why you form a C corporation. It's probably the strongest, it's definitely the strongest asset protection entity choice you can have. Okay? I don't know what this is. It says Elena has entered the waiting room. I guess I admit someone in the waiting room. Is that correct? Yes? Yes. Okay. Yeah, I don't know. Sorry, I don't know all this stuff. I only go on these calls, and I'm usually not running them. I apologize. Okay? So to get that protection, though, C corporations are heavily taxed, double taxation. That is, the entity itself is taxed like an individual, except it's a personage status. And then the dividend to you, the shareholder, if you're the owner, are taxed as well. Okay? Basically, like I said, this entity choice has been around The oldest U.S. Supreme Court case dates back to 1819. Okay? What is important is the income is only taxed to you, the shareholder, when it is distributed. So if the company makes $100,000 a year, but you never distribute any of the money in form of payroll or dividends, then you, the owner, never get taxed, ever. That's different than other pass-through entities. This is a standalone entity itself. So it's taxed itself. So under the new rules, $100,000 of income, you pay of net income, or taxable income, you would pay $21,000 in tax. You as the owner would not be taxed on that at all because the money had not been distributed to you as of yet. Does that make sense to everybody? Yes? Okay, great. Okay.
Question?
Sure. Go ahead, Mark.
Hi, how are you?
Good.
And if that was given to you, you're saying, do you consider a salary a distribution?
No, a salary is going to be, you're distributing the money out. There are two ways to get money out of a C corporation. You pay yourself a salary. That means you're an employee of your own company. I'm an S corporation. I'm an employee of my own company. The other way is to issue yourself a dividend. So the salary is like if you worked anywhere else, right? You pay yourself, if the company made $100,000, say $100,000 of income, you paid yourself $20,000 of salary. You'd have withholding tax, FICA taxes, and everything else like that. That's one way to get the money out. Let's say you don't do that.
You pay personally that on the 100,000.
Yes, you would pay yourself personally. Let's say the $20,000, $100,000 of income comes in. You pay yourself a salary of $20,000. You would pay Medicare taxes, Social Security taxes, and then you'd probably have some type of income tax withholding at the federal or state level. That's one way to get it out. The other way to get it out, or you can do it either way you want, you dividend the money. So let's say you have $100,000 in net income, right? That's the profit at the end of the year. Then you shoot yourself a dividend up. That's taxed as passive income, okay? And that's taxed more or less as ordinary income, the same as your salary, okay? Now, if it was a capital gain, meaning you sold the stock of something, that's a little different tax rate. We're not going to get too much to that here because we're not really talking about the difference between income taxes and capital gains here. But for your purposes, the two ways to distribute the money out of a C corporation, this is a very important question, is salary to you as the owner or dividend the money up. And always think of it going upwards. That money is just getting out of the company, right? And it's moving up. So here's the company, here's you, your money goes up. And then that way you would get taxed on that. Does that make sense? Yes? Okay,
yes.
Great. Okay. So basically there were some recent changes. They're not so recent anymore, but I still like to put them out there because I'm assuming most people on the call here are not tax experts. As I said before, the tax rate now is 21%. For corporations, no longer 35%. The corporate AMT was something called the alternative minimum tax. Won't get into that too much. It just meant you had to pay a minimum tax under a different taxing system if you weren't taxed at a certain amount on the regular taxing system. Huge thing is you go out and you build your C Corp, you buy a bunch of property, you can take 100% bonus depreciation, which means you can write off large purchases, which you couldn't do. And then there were major changes that happened for foreign profits and repatriation, okay? So these were big things that happened, and if you went down the road and formed a C Corp 5 years ago, you would now be paying less taxes this year than you would have 5 years ago, or even 3 years ago, okay? Other things that were big, just so you know, for those who are forming companies, this is important as a point of reference, especially if we're in an election year. Some of these things could revert back. As we all know, we're following an election. There are a lot of things up in the air. Corporate tax rates, if the administration changes, could go back up. Other things could change. One of the big things here was the meals and entertainment deduction. Back in the day, 3 years ago, you went out for a meal with a client, or you went out and had entertainment, you went to a ball game, 50% of that was deductible. Now, it's only meals. So this is a big thing. If we were in non-pandemic times and I went out to a Yankee game, all that I spent that night will be subject to a 50% tax deduction I could take. Now, only the meal portion of the day can be taken out. That has before pandemic, that had a big effect on things like charitable events and things like that. Also, certain fringe benefits like parking and things like that are not tax deductible. Okay. Also, I'm not going to get into this too much. Business interest expense is now limited on its deduction. We're not going to get into the minutia of this, but just know under the old days, any interest you had that you borrowed on behalf of the company, Jack Sullivan Inc. borrowed money, I could take a deduction on the interest I paid. Now it's a convoluted calculation as to whether I can actually take that deduction or not. Okay? And that also applies to pass-through companies too. The great thing about C corporations, tremendous amount of ownership flexibility, virtually no limitations with respect to the type and number of shareholders and stock you can have that a C corporation can issue. Basically, it's the most flexible of all the things we're going to talk about here. And they also pay out income as deductible compensation to a shareholder employee that Mark had asked about, provided the amounts are reasonable. And out of all these choices we have, it's really the only thing that can be publicly traded. That means you can buy the stock. There are exceptions, things called REITs or publicly traded partnerships, PTPs. We won't get into those now, but in general, anything that you can buy in the stock market, that's generally a C corporation. Okay, does that make sense? Great. Again, as I said, it's the only thing that's basically publicly traded. There are exceptions, REITs and PTPs. One thing too is if you have a C corp and you want to convert it to an LLC, that will be taxed as a partnership. Sometimes that's done. That can cause a very, very large tax bill. Just so you know, the reason that they're having this course is either you folks either have a business right now, a business idea, or you're about to form a business, or maybe you already formed one already. When you choose that entity type, it's very important because you're kind of stuck with it for a while. And even if you want to change it, let's say 5 years from now, then you have to analyze whether changing that your entity choice can result in a tax bill. So if you don't properly plan this out, you could have a significant tax bill if you choose the wrong entity type in the beginning. Many times I've had clients come into my office and say, oh, I formed an LLC in Nevada. I'd be like, why'd you do that? Well, I Googled it. It seemed like a good thing to do. I'm like, why? And then they explain it to me, and then they're actually paying more in taxes than they should because they should have been an S corp or a partnership or something else like that. And then from there, they either can dissolve it, reform it, or convert it, or just hold on. So you always want to be careful in the beginning. For those of you on the call who haven't formed their companies yet, you want to make sure you're choosing the right entity to do this. You don't want to just willy-nilly do it. You want to do your research. Like when you go into the doctor, you want to ask a lot of questions. I'm not a CPA, although I started a CPA firm. I work with CPAs every day. And sometimes my CPA brethren and business lawyers' knee-jerk reaction is form an LLC. That is not always the answer. As you'll see by the end of this presentation, you'll be like, wow, I didn't know we have to put so much into this thought, because there are really significant tax implications as to what entity choice you form. Make sense? Okay. Now, one thing that came out under the tax bill was, yes, okay, the C Corp, the tax rate went down, but if you have a pass-through entity, remember I talked about those S Corps and partnerships and things like that. Now you have these pass-through entities. Now you get a 20% deduction, basically, off of your income in more instances than not. That's the new Section 199A deduction, which was a nice benefit. The one thing about the tax bill that I didn't like a lot about it, but I did like certain things about it. I liked reducing the corporate rate. I did like this 199A deduction, okay? So basically, if you have net income of an entity, you have $100,000, as long as you meet certain criteria we're going to discuss, you can then deduct on your personal return $20,000 or 20% with certain restrictions. Okay. One thing about that, there are income limitations. If you exceed certain financial thresholds from an AGI, which is your adjusted gross income perspective, then there are limitations on availability of this deduction. And just so you know, I'm going to be giving you a lot of information here. The most important thing about this is that I'm not in the room with you folks. Normally people are looking at me like, wow, this is a lot. You don't need to fully understand everything I'm saying. Just it's supposed to pique your interest, make you know that you have to think about this, and honestly make your decision cautiously. Talk to other advisors, think about it, do your own research. You don't want to just do a knee-jerk reaction. That's why Hofstra, I've been doing this now, I think for 5 years, has folks like me to come in and talk about these things, so at least you know what you're getting into in a good way. Because owning a business is great, but you want to understand why you're choosing your entity and just not do it and understand, okay, I need to understand all this. Because within the 4th or 5th year, you should know a lot more about taxes than you know now. Because at the end of the day, the old saying, it's not what you make, it's what you keep. And tax choice is the most important thing you can do through your entity. If you don't choose the wrong one and you're not structured properly, you could be giving a lot more to the government. And you don't get anything for giving more money to the government, I can tell you that right now. And you don't want to do it. I'm all for fair participation and paying your due amount that you should, but you don't want to pay more than you have to. Okay? And we won't go too much into this, but just know if you hit some of these limitations, and you'll take a look at this offline, then there are limitations on how much that 20% can be reduced, and that works off of the wages that you're paying or distributions you're paying through your pass-through entity. Okay. The one thing that is important, though, is that when the bill was passed, the president and his tax advisors put some hard limitation, hard cap on certain businesses. So most businesses, you get this 20% discount, if you will, or deduction for any kind of business you own, except for something called specified service businesses. Those are very specific. In the law, black letter law, doctors, lawyers like me, accountants, actuaries, and consultants. Mind you, consulting is a very, very big term. Athletes, artists, people in the financial services or brokerage industry. One thing he had in there that was a catch-all originally was any trade or business with a principal asset is the reputation or skill of the owner. The IRS then came out and narrowed that and said promotional work only. But originally, people were very concerned about that. Because let's say you had, I don't know, John Sullivan garbage removal. They could say, well, I'm getting it because John Sullivan's the best garbage removal guy out there. And people were very worried that you couldn't even have your name attached to your business. Then the IRS came back and they narrowed the scope of that deduction. Okay? Just know that if you have one of these SSBs, specified service businesses, and you cross over those financial thresholds before I showed you, you don't get any deduction. In my opinion, this is openly discriminatory. And if any of the large law firms or accounting firms took this case to court, took this issue to court, and it got in front of the Supreme Court, it's possible they could overturn the law because it's discriminatory against certain industries. But that's not happened yet. I doubt it will now with the pandemic and everything else is going on. But this is a big thing. So if you're an attorney or an accountant or a consultant, you want to be aware of this because this deduction may not be fully available to you the more money you make. Okay?
Good question.
Sure, Mark.
I saw those earnings, numbers.
Yep, there you go.
So two actual questions of this. If the threshold is, why are they defining it as the low number? Because
it phases out. Because it phases out, Mark. I'm sorry. I didn't want to get too much of the weeds on this because it phases out. Yeah. Mm-hmm.
And the other question I just have is that when you can't get the deduction, is that from $2,007,550, 501?
Yeah, basically once you hit. So for me, right, as a lawyer, if my AGI and my tax return before the deduction is 207,501, I lose the whole animal. If it's 157,501, I phase out over that $50,000 spectrum, right? So 157,501 is a convoluted calculation I didn't put here that I slowly start to lose my 20% over time. Once I hit 207,501, then I don't get anything. Meanwhile,
from below that, you're talking about anything at all.
Right. Once I'm at 207,501 as a single male, which I'm still, even though I'm engaged now, once I cross over that threshold and I'm married, okay, then the number goes 315 to 415. As a single guy, 207,501 AGI before the deduction, I get none of the 20% off. However, if I was John Sullivan copier guy, then I would get it through a different calculation limited through that W-2 wages slide I showed you. And that's another convoluted calculation. But the reason I point this out is not for you to fully understand, but to know that this is out there. And you want to be careful about, if you're a consultant, and we'll talk about everyone's businesses once we get through the second half here. But you want to be careful the way you categorize yourself. Me, I have no choice, black letter law. But if you're a financial service guy or a brokerage guy or a consultant guy or girl, apologize, ladies, you want to be careful about that because once you put down that categorization, you're kind of stuck to it. So this is a great deduction, but you don't want to get hemmed in. I've got nowhere to go. And once I learn what your businesses are, some of you folks might be hemmed in with me. Hopefully none of you are. But it's important because this deduction is a material dollar amount. 20% off your net income of your business is a lot of money. So that's why I put this out here. This was never here until they changed the law, but I want people to know that because I feel I'd be committing almost malpractice, which I'm not, I could never do, by not telling you, be careful, how do you categorize your business? And that's why this tax law is a little weird. I don't think you should have to worry that much about this, but this is the law. So I'm an advisor and I'm just teaching a class and letting you know, be careful because you could lose this deduction if you don't categorize yourself properly, if you have the opportunity to drive outside the lane of these different SSBs, wherever they are.
Right. So if you get to 208,000, you want to buy an extra copier.
Right.
For the business, so you're back down. That's crazy that you lose all the first
No,
two.
it's not the business income, it's your income. AGI.
Right, but you can determine in your company what your income is going to be by basically just hitting
by your payroll, right? So that's another thing, and that's why, great point Mark's making here, but he doesn't know he's making just yet, I'll tell you. That's why you need to have a good small business tax accountant or tax lawyer to work through this type of stuff. So when you're going through this, right, what Mark just says, like, wait a second, okay, I want to make sure I don't go over that threshold. There's a lot of articles written on how you balance the income of the business versus the payroll you pay yourself, especially if you're in one of these SSBs.
But Jack, I just want to say I did know that because when you had that 50% deducted dinner last night you took me to, you told me to say that.
There you go. Smart man. I like your sense of humor. Wish we were all in the same room. It'd be a lot funnier. Great. Okay, so let's move on from this. Okay, so that's C corporation. We talked about the 20% for the pass-through entities. Now we're going to talk about the type of pass-through entities. That 20% we just went through, the 199A, that applies to these pass-through entities. The C corporations are not pass-through entities, so none of that applied. We talked about the 20% deduction. This applies here. So my favorite entity choice, which I am, is the S corporation. Okay? Basically, it's a C corporation that satisfies the requirements of subchapter S of the tax code, and you make an election. You literally file a form 2553, okay? And that allows you, if you meet certain criteria, to be an S corporation. And S corporation means small corporation, to be honest. It's very simple. And basically admitting shareholders and transferring of interest between shareholders can basically be a little bit difficult. And there's strict revenue allocation, which means allocating the income between the shareholders is strictly done through basically how much you own in the entity and what the contract or the operating agreement has. But basically, if Mark and I were partners 70-30, really we have to allocate our revenue 70-30. LLCs, not really like that. Partnerships, to a degree, are like that. That's why some people don't like S corporations. That's why some people love the LLC, because you can kind of do whatever you want. Okay, does that make sense? Great. So if you're an S corporation, all of the following requirements have to be met. All of them. If you don't meet them, then the IRS, if they find out, will disallow the S corp and treat you like a C corp, and then everything is subject to C corp tax. Okay. Only domestic corporations or eligible entities can be the underlying entity. That means the company that we form from a legal perspective. Generally, only breathing individual people. Corporations are considered people in a weird way in this country, but you have to be a breathing person to own it. So corporations cannot own an S corporation. A partnership cannot be a shareholder of an S corporation. Also something unique, only U.S. citizens or residents can be shareholders. That's not true of a C corporation or any other entity. Only S corporations. Why they did that when they passed it, I don't know. I wasn't around for it, but that is the law. It's never been changed. Only one class of stock is allowed, only one. And that's a big thing as well. So basically, like I said, with C corporations before, you can have God knows how many classes of stock. When I worked at the telecom, we were on what we call the F round. We had A, B, C, D, E, F series of stocks, different stock class holder shares. We had all different levels. Here, S corp, one level, that's it. It's all class A, if you will, okay? And you can only have 100 shareholders. Obviously, C corporations, you can have as many as you want, especially if you're publicly traded. Partnerships, LLCs, you can kind of really do whatever you want. S corporation, 100 is the maximum. You break any of these rules, if the IRS finds out about it, they come in, they reclassify you as a C corporation. Again, pass-through entity. So that means generally no tax is paid at the entity level. When you do your S corporation federal return, the 1120S, there's no tax due. The income, the net income of the company, passes up to your personal return. Any payroll you pay yourself would just be like if you were working for anybody else. So on whatever line in the tax return is, let's say it's line 4, your payroll will be there. Then on like line 12, there's net income from partnerships, LLCs, or S corporations. That number goes there and passes up to you, okay? Some states, including New York State, impose fees or minimum taxes. Interestingly enough, New York City, where I live, and I am right now in my office, they do not respect S corporations, so your tax is a C corp. So just if you're a C corp or an S corp, you're basically taxed the same way. New York City uses two different forms. There's a little bit more to it than that, but generally you're taxed the same way, okay? Again, the tax is paid only at the shareholder level. So if I made, let's say, $100 this year, I paid myself $20 in salary, and the company made $30, then on my personal return, I have $20 in salary, $30 in net income. I have $50 of income, taxable income for the year if I didn't have any deductions. That would be passed through to me individually on my personal return. Okay? Interesting little nuance that most people don't know about. New York City has a major loophole in their law. Basically, New York City property, income producing or investment property should not be held in S corps due to unincorporated business tax loophole for unincorporated entities. So, if you own property in the city of New York, you don't want to be an S corp because then you get taxed on it. However, basically, if you hold it in what's called an unincorporated business, which would be an LLC or a partnership, there is no New York City tax. So the building in which I sit, which is owned by basically a real estate investment trust, they don't pay any tax on any of the rent of any of us what we pay here. However, I pay tax as a city business owner to the city. Meanwhile, the guys that own this building don't pay anything because they own it in a partnership. Big, big deal. Huge, gigantic loophole in New York City law. People complain, oh, how do we make New York City taxes more fair and everything else? So if you want to change the law, that's the big way you could do it. Most people don't know that, but it's a huge discriminatory piece of legislation that's been around for years, decades actually. Okay. Another important thing, and this is very important, the biggest thing you're going to learn from this is something called self-employment tax. Everybody here know what self-employment tax is? And I can't quite see everybody. Does anybody? No? Okay. So self-employment tax is really tax on being self-employed. So shareholders of S corporations don't pay self-employment tax on the net income of the corp and their distributions if they're actually engaged in the business of the S corp. There's also called additional Medicare tax under Obamacare, and they don't pay that as well. It's a big, big deal because partnerships do pay self-employment tax on the profit of the company. So in other words, when I pay myself a salary, I pay myself a salary. And for those of you who don't know, when you're an employee, the company pays your side of FICA and Medicare and Medicaid tax, and then you also have that withholding too. It's called a match, right? But the profit on the S corp that flows up to you, there's no self-employment tax. However, the other pass-through entities, which I'll talk more about, and this is a big tax differential issue, that's why you want to choose carefully. Anything like an LLC, a partnership, things like that, that profit, you do pay self-employment tax. And we're going to go through examples on how that shows up basically from a net perspective on your tax return, how it costs you money if you don't choose the right entity choice. Okay? Now, if you're an S corporation, you should be paid a salary with wages reported on a W-2 and the Social Security and Medicare taxes are already withheld. Every quarter, every month, I'll contact my payroll provider. I'll say I paid myself $100 in salary, and they'll do the calculation on what my Social Security and Medicare taxes are. Okay? It's a big thing, and it's something you'll learn if you do an S corporation. One of the unique things about it is in the first few years, you can do a lot of fun things with payroll timing and cash flow. So basically, if you want to, you can draw income all year, pay yourself all year, really not report it from a payroll perspective, and then at the end of the year, say, okay, Mr. Payroll Provider, I pay myself $10,000 this year. I want you to hold $2,000 at the federal level. Please calculate it. They do the calculation, and then it basically gets annualized back to the beginning of the year. So if you really run your own business, just you, I'm a sole S corp owner, I don't do that. I pay either quarterly or monthly, but you can actually do that if you want. Some people do that. I don't recommend doing it because the tax bill at the end of the year can be huge. But if you don't want to pay the money to the tax man, you can wait almost to the end of the year, and then your withholdings goes all the way back to the beginning of the year. You can't do that with an LLC or a partnership. You can't do it because you got to make quarterly payments and things like that, which we'll go more into later. Now, big difference too. As corporations, you pay yourself a salary. LLCs and partnerships are not supposed to pay salaries. Okay, so you basically do a draw. Then you make a quarterly estimated payment to the IRS. Otherwise, underpayment penalties can apply, and this can affect cash flow of a closely held LLC. Okay? Someone have a question? Nope. Okay. So payroll for shareholder employees versus profits. This is what I was talking about before. There's a strong temptation to pay yourself a lower salary and a higher profit distribution because the wages are subject to FICA payroll taxes. So when I pay myself a salary, I'm paying the FICA as the employee, and I'm paying the FICA employer match because I am the employee of my own company. However, when I have profit, there is no employee in FICA or Medicare taxes. So you got to kind of balance it out, but you don't want to have made too much money and then pay yourself nothing. Okay. As I said before, profit distributions are not subject to FICA tax. They are only subject to shareholder income tax rate. It's a big difference between LLCs and partnerships. So what a lot of people do, and they get themselves in trouble. Let's say your company brings in $1 million of profit. You're like, okay, great. You know what I'm going to do? I'm going to pay myself a salary of $20,000, and the rest of it's all going to be profit. The IRS could step in and say, that's not reasonable. No one with $1 million of income that runs a company would ever pay themselves $20,000. So you have to be very careful on how you pay yourself. Okay? That's the number one audit risk for S corporations is salary and wages paid. And you get huge audit problems with that. Now the question is, what's reasonable wages, right? Zero salary is unreasonable. No one works for free. Salary below minimum wage is unreasonable as well, because obviously you don't want to go down that road. Salary far in excess of an appropriate wage is also unreasonable, because then it's tipping the other way. So paying $1 million salary when an officer is a similar position would expect to make only $150,000 is also unreasonable. So this is again is why you need a good advisor, someone who kind of knows, okay, how does your business run? What are you making? Good example is my first client in New York City that I got on my own, I don't know, 20 years ago now. They're a wine store here in the city. Okay, and they make, I don't know, they bring in like $1 million a year. And in the beginning, he was underpaying himself a great deal. I'm like, if you keep doing this, you're going to get audited. So we doubled his salary, and we've never been audited in 20 years. Knock on wood. In the beginning, him and his brother recently died, but they were paying themselves nothing, and they were making a lot of money, and they were taking the profit out, right? And they weren't paying self-employment tax. I'm like, that's an audit risk. Took me a few years to convince them, and they finally listened to me. Luckily, we never got audited. But a lot of times people try and play that game. That's why it's always good to get a lawyer, business consultant, good CPA who knows small businesses can kind of guide you through this minefield. Because trust me, you don't want to be audited. Okay? Big thing between the L and the S Corp, again, S Corporation distributions to owner employees are not considered net investment income, okay? That's a big thing. This means that distributions of an S Corporation earning are not subject to that Medicare surtax we talked about before under Obamacare, which you only get into a certain level of income. However, in contrast, both wages and distributions to an owner employee as of a business or taxed a partnership are subject to payroll tax and Medicare surtax. So another benefit of being an S Corp. So you're an S Corp, you don't get hit with the Medicare surtax from Obamacare, but if you're a partnership, you do get hit with it. Okay? And we've already talked about this, we won't get into too much, but this is basically the biggest audit risk we've got. Okay. Any questions on an S Corp before we go through the comparison to partnerships and LLCs? No? Great. Pass-through entities we talked about before. Partnerships were the first ones out there, along with F corporations. Partnerships we're going to talk about before LLCs because partnerships existed first. Basically, that's a separate entity, like an S corporation, from its partners for tax purposes, and the income and the losses pass through again up to the partners, okay? Similar to S corporations, you pay the tax at the partner level. Different types of partners are allowed. An admission of new partners, transfers of interest are much easier than S corporations. They come in many different forms. Most people don't form partnerships now. You either do a corp, an S corp, or an LLC, but this was before the LLCs were used in the 90s, so that's why we're talking about it. And it kind of builds off why LLCs exist and how they're taxed. So general partnerships, basically a general partnership, basically everyone is open to unlimited liability. Limited partnership, limited liability, and limited liability partnerships means no one has any liability from a general perspective, okay? General partnership, unlimited liability for partners if they're active participants. And you're subject to self-employment tax on the income. You never want to be a general partnership. that means I'm partnered with somebody else. I'm a general partnership. That means if I make a mistake, they can sue me, my business, and me personally. They can go at my house, my pension, everything. That's what's unlimited liability. You never want to have unlimited liability. No one really forms general partnerships anymore. They're rarely done. I don't think they're ever done anymore. And the laws now have gotten much more favorable to people to have limited liability. But that's how partnerships were formed many years ago. Then you have limited partnerships. Usually, back in the old days, you'd have one general partner, and then the other partners would be investment or limited partners, and they weren't actively involved. Again, the general partner would have unlimited liability, and again, subject to self-employment tax on their income, okay, on the income profit of the company. Limited partnerships, limited partners would have personal asset protection, and they would not be subject to self-employment tax. Okay? Limited liability partnerships came along in the late 90s. Okay? They don't have a general partner, since every partner in an LLP is given the ability to take part in the management of the company. However, limited partnership can only be formed by certain business types. Okay? You have to be in certain professions: accountants, architects, engineers, and lawyers. You have to have a license to do what you're doing. Okay? And then every partner in the LLP has to have a license, an occupational license, if you will, and then all profit and losses go basically up according to what the ownership interest is. Okay? So basically, you're limiting the liability. This happened in the 90s, right when all the accountant firms were changing and they were growing, and they went from the big 8 to the big 6 to the big 4. I'm originally from Coopers & Lybrand and PricewaterhouseCoopers. When I graduated college, I worked at Ernst & Young. That was right, I guess that was 92 or so. They became limited liability partnerships. Those were the first ones that were out there in the early 90s. So we talk about the partnerships. We go into the LLCs because LLCs basically pay taxes like partnerships. There's no federal LLC form. There's federal partnership tax forms. So that's why we talk about partnerships first. No one really forms partnerships before they form LLCs. They're much easier to form in general, and there's a lot more or less easier to form, a little bit more expensive. There's a lot more freedom on how you allocate your income and your profits. So an LLC, limited liability company, not corporation, important distinction. That's created under state law. Has the characteristics of both a corporation, and a partnership. Like a corporation, the owners are usually not personally liable for the debts and other obligations of the LLC. Like a partnership or sole proprietorship, an LLC has great flexibility in the way it operates. Great flexibility. You don't have to follow corporate formalities, such as holding special and annual meetings with shareholders and directors. None of it has to be done. Okay? LLCs are not subject, unlike S corporations, to restrictions on the number and types of shareholders or the one class of stock limitation. That's a huge thing. Members have flexibility to allocate income or loss on basis other than according to each membership's percentage interest in the LLC. So basically, if I'm an S Corp member with another person, 70-30, we kind of have to allocate everything that way. LLCs, you don't have to do that. You can have one guy invest $2 million, the other guy or lady invest $5, and you can allocate the profits any way you want, issuance of dividends and things like that. Big difference, and that's why a lot of people choose LLCs. Okay. Now, the one thing that's interesting about an LLC is there's no federal form. So you have to decide how you want to be taxed. Okay. You form your company at the legal level, at the state level. Let's assume everyone forms it in New York. You form it as an LLC. You go to the Secretary of State. You say, fine, I'm an LLC. This is how I'm forming with the Secretary of State. Then you have to decide how you want to be taxed. Okay. You can be taxed as a partnership if there's more than one LLC member. You need 2 to be a partnership, right? 2 people to be partners. S corporation, believe it or not, you can form yourself as an LLC, taxed as an S corporation, or a C corporation. Or in the case of a single member LLC, that's one person, you can be disregarded as an entity for federal tax purposes. And disregarded means there's no form you have to file. You become a single member LLC. If anybody's looked at a 1040 return, and since everyone's sitting at home, you could actually Google this. You can look at Schedule C on your 1040. If you don't check the box to do anything, and you're a single member LLC, that means you're the only owner, then by default, you become a disregarded entity and you file your tax return for the business on this Schedule C in the 1040. So behind the main pages of that, Schedule A is itemized deduction, Schedule B is dividends and interest, Schedule C is your own business. Okay? So single member LLCs, LLC that only has one member. Usually a member checks the box, makes an election to have an entity disregarded. This means, again, you just fill out the Schedule C and that's how you file it. One important thing about Schedule Cs, they get audited all the time by the IRS. S corporations have the lowest audit rate. C corporations are highly audited because they know most of the time you're doing it yourself and they assume, honestly, that you don't know what you're doing. And a lot of times when people file these things and they're not having someone sign off, you get audited. I had an interior designer. I've been in business now 8 years. She's now in her third audit. Third time it's been audited in, well, I got her before I came on board. So now it's 10 years I've had her. This is her third audit. She keeps filing on a Schedule C. I keep telling her to convert to an S corporation. She doesn't want to do it. And the IRS keeps coming in. She doesn't have that much income, $200,000. I'm not saying that's not a lot, but other people I do business with have a lot more and they keep auditing her. They disallow cab rides, meals, and everything else. So I'm not a big fan of the disregarded entity filing on a Schedule C. It's highly audited. Okay. Now, if an LLC chooses to be taxed as a partnership or an S corp, or if a single member affiliate elects to be disregarded, the profit and losses are reported on the person's individual tax returns we talked about. Most multi-member LLCs choose to be taxed as partnerships. That's why we talked about that before. Most single-member LLCs elect to be disregarded, which, again, I don't like, but that's generally the statistics and the way they play out. Other important things. All non-passive income is subject to that self-employment tax I talked about. Real dollars, over 13.8%. Great thing about it, though, LLC interest easily transferable. Very often used for entrepreneurial enterprises with small numbers of active participants. And deciding to convert an LLC to a corporation later generally has no federal tax consequences. So a lot of times people form LLCs, they get investors in, right? And then they try to get the investors out with their money, and either they run the business that way and they continue, or maybe they go public. If you ever go to a movie, not like any of us are going to movie theaters right now, but at the end, usually you'll see an LLC, that's the name of the movie. So if you were to see, I don't know, basically you go out and you saw Schindler's List, probably at the end it said Schindler's List LLC. Anything that comes out right now. I recently saw the Trial of the Chicago 7 on Netflix, probably on there. Trial of the Chicago 7 LLC at the end. You get money in, you get money out. Easy to dissolve the company, the LLC. Very easy that way. You can basically do whatever you want with it. A lot of freedom with the LLC. That's why it's used as an investment vehicle a great deal of time. Also, hotels are often used that way too. So hotel chains will just form separate LLCs to form other hotels under it, and usually each hotel is its own company or LLC. Another important thing, partner members pay self-employment taxes. Again, this is the partnership taxation of the LLC that we talked about it. S corporation shareholders only pay personal income tax and profits, but not self-employment tax. And this has a material effect, and we'll get into that in a little bit. That's a big deal. So again, when you do your 1040 tax return, that income that flows through on line 12 or whatever for your flow-through entity, let's say it's $100,000. If you're an S corporation holder, that money just flows through. And on the second page of the tax return, there's a self-employment tax calculation. No self-employment tax in the profit of the S corp. If you're an LLC, partnership tax that way, that money is taxed, and it also pays income tax and self-employment tax, which can result in material tax dollars, which you get no benefit for, but you have to pay it, and there's no way around it. And an important thing about that too, has anybody here ever heard of an NOL by any chance? Anybody know what that is? I can't see anybody, so I don't have everybody here. Does everybody know what an NOL is?
No.
No. Okay. So an NOL is a net operating loss. So if anybody's following anything, regardless of your politics, all the things they've been talking about, the president's tax returns, he had things called net operating losses, which means his business has lost some money, and then those losses from those flow-through entities move forward to each year. That's called a net operating loss. So if my business loses money this year, let's say I lose $100,000, right? In 2019, let's say, but I can't use all that loss. I file my tax return in 2020. I have $150,000 income. I could take my net operating loss from 2019, offset my $150,000 of income in 2020, and voila, I have $50,000 of net income, right? People do it all the time. However, self-employment tax can't do that. I have a client right now, okay? They gave themselves large distributions from their LLC. That's subject to self-employment tax along with the profit of the company. They had huge NOLs, though, as well, from other entities. Those NOLs could not offset the income and the self-employment tax. So they're on the hook right now, roughly for 600,000 American dollars. And I'm working through an offer and compromise for them. So that's an important thing, a big, big difference here. Just know that self-employment tax bill doesn't go anywhere. You got to pay it. There's no way to offset it. Really, credits don't offset it. So if you pay you have to pay self-employment tax because your LLC makes money. There's really no way to ever get rid of it. Does that make sense to everybody? Okay. So what we're going to do here, and if I'm looking over, I'm just checking my watch. We're at about a little before 7. We're going to run through an estimated tax bill. Because at the end of the day, it's like I said, it really comes down to not necessarily what you make, but what you keep. Before I go through this, does anybody have any questions? Let me put everybody up on screen here. This is a good time to ask me any questions if you want before I go through the calculation. Anybody? I don't know if I can see everybody here. Nope. Okay. All right. I'll go forward. And everyone's unmuted, right? You can talk at any time, right? Mm-hmm. Okay. Good. So what we're going to do, great, good. So we're going to compare an LLC to an S Corp. And again, I've done this twice a year for 5-6 years now, and everyone's eyes glaze over when I do it. You don't have to memorize or remember this. Obviously, there's no tests. Just keep your eyes on the net figures at the end. That's what's important about this, because at the end of the day, it is about money. I'm assuming everyone here is some level of a capitalist. They want to have their own business. And again, I believe that people should pay their fair share, but you don't want to overpay. And you're not going to understand the calculations right now unless there's someone here who's a tax person. But just look at the way the numbers flow. And remember this when you're looking at this offline. This presentation is important. When you go to your tax advisor and you decide to form your company, sit down with them, print this out and say, hey, I heard this raspy voice New York City lawyer say all this stuff. And I think it kind of matters because I don't know if I want to be this or that because I don't want to overpay taxes. And then your CPA or your tax advisor will be like, well, that may be the case, but here's the reason you have to do this. So you kind of got to balance tax bill, asset protection, and growth. All those things I talked about, okay? So we're going to talk about LLC versus S Corp. We're going to assume the S Corp and the LLC are not eligible for this 199A thing I talked about, just to make the calculation simple. Otherwise, your eyes will really roll over, okay? But we're going to say no matter what, under the current interpretations of the law, the 199A is the same for all types of pass-throughs. The only difference is if you fall into those SSBs, which you're not going to get into. We're just going to assume the 199A doesn't matter here because it would all came out the same in the wash. Okay? So here's our scenario. Taxpayer is married filing jointly, MFJ. Okay? That means you and your wife, you and your partner, you're filing a tax return jointly. Your partners actively participate in the business as two owners, A and B. The S corporation we're going to do first. Okay? 700 of revenue, 700,000 revenue, 80K of expenses, 420,000 of salary. That results in $200,000 of net income for the S corp. Okay? $200,000. So we're going to work off personal return of A. And as you folks are running your businesses, you're going to learn every year. The most important thing is for you is what the heck my personal tax return looks like. And that's the most important thing I can tell you. Just like going to the doctor. Get a good tax advisor. You're going to want to learn the tax laws yourself. Ask a lot of questions because at the end of the day, it's what you keep. Because you can make a ton of money, but if you're paying all the money to the government, you're working for free. So now, on my return, let's say I'm A, I have $310,000, right? $210,000 of salary and 100K of S corporation income. Okay, none of that income is subject to the Obamacare surtax. Okay, here's my tax bill. Arguably, rough numbers, $117,000 on that salary times 15.3, 17,901 of employment taxes. Okay, 93,000 of Medicare tax, 310,000 times 24% because that's the new tax rate, 74,400 of personal income tax. Now, note on a tax return, if I'm doing it technically correct, I also get a tax deduction for half of my employment tax. But we're not going to get into that here, okay? The state, 310 times the current rate, 665. City tax, 100,000 of profit, 885. My tax bill to the S corporation at the city level and the shareholder, 124,463. The one thing that you're going to learn is making money costs money. But at the end of the day, if you're paying taxes, it's not a bad thing because that means you're profitable. You know, in my business, when I first came up out of law school, I worked at the Big Four, Coopers and Lybrand, like I said, and my boss taught me something I still say to this day: pigs get fat, hogs get slaughtered. So as your business grows and you get more complicated and more complex in understanding of taxes, you don't want to get too aggressive, because if you get a little too aggressive, you can get audited. So sometimes your first temptation is, I don't want to pay any taxes. Paying taxes is sometimes a good thing, because a lot of times if you aren't paying taxes, you're more likely to get audited. If you're paying taxes, paying something that's reasonable, the IRS usually will just not look too much at you. If you start trying to pay no taxes ever for years and years, one day you could get an audit notice. And then you got to call a guy like me, basically, to represent you. And that's not a cheap endeavor. You don't want to do that. You want to basically prevent it from happening. You don't want to respond to it happening. Trust me. The old saying was, for those who are around my age, you'd rather call me now than call me later. You want to prevent the problem. You don't want to react to a problem that you caused by being too aggressive. Okay? So now we have the LLC. Same story. Same thing. Two partners, same exact story, right? 80 grand in expenses, 420 though of partnership distributions, right? No salary, results in 200,000 of LLC corp income. Taxes of partnership. So 310,000 income goes onto my return. 210 of draw and 100K of S corp net income. Okay? Now already 60,000 is crossed over to the 250 Obamacare threshold, and I have Medicare taxes from Obamacare. Okay, now things get sticky. Tax bill at the federal level, additional Medicare tax, $22.80. On top, there's a Medicare surtax, $540. The employment tax and the Medicare tax are the same. Then, there it is, employment taxes, self-employment, $15,300. Everything in red was not on the S corp calculation, okay? And then $74,400 of personal income tax. Again, no employment tax deductions being taken. Okay, same tax at the state level. The one thing that goes down is the city, because in the city I pay a lesser rate, 4%, because I'm an unincorporated business tax. Now my tax bill is $137,733. Net, I pay $13,270. Now, that's a lot of money. Before the pandemic, that was probably 2 weeks in Italy. I don't want to give 14 grand to the IRS if I don't have to. And these are small numbers if your business is making a lot of money. So that's a real reason you want to take a look at these things. Obviously, the more money you make, the larger these things get. So you want to be careful. The reason is, let's say you form an LLC, two partners right now. And let's say you never come into New York City, which a lot of people in this class don't. They're just on Long Island. So they don't have to put money in the city and pay these additional taxes. There's really no upside if two partners form an LLC because you're just paying more in tax, unless you're having people come in and out. We're going to talk more about that later. So you got to be careful, because otherwise you're just literally throwing money away. And I've met many people who are like, oh my God, I guess I shouldn't have formed that LLC. And I'm like, no, probably not. Okay. We're going to cover this here and then another 15 minutes. Anybody have any questions?
Oh.
Nope. Okay, great. So here's some steps for formation of the entity itself. And I don't know how many people on the call here have actually formed their company. When I first started doing this, I didn't go into it. But then people always ask me these questions. So I think it's important to step through how you form your company. And if you formed it already, then I apologize, but I'm assuming everyone on the call hasn't already formed their company, because generally that's been the case. Okay, so people are shaking their head no. Great. In general, what you do is you go to the Secretary of State. Does everybody know what the Secretary of State is? Anybody? Yes, no?
Pompeo.
Excuse me?
I said Pompeo, sorry.
Yes, that is Mike Pompeo. That's right. That's the U.S. Secretary of State.
Yeah, I know.
Right, yep. So in state law, the Secretary of State is basically the legal arm, the enforcement division, not the Attorney General. Secretary of State is basically the legal arm of the state where you form things, okay? Amongst any other functionalities. So what you want to do is you literally would go, if you want to do it yourself to start, you go to the Secretary of State website and you do a name search, okay? Let's say you find something unique, okay? You find P. Washington Flowers, right? LLC. You do that search. You reserve that name. You pay a fee for that, right? You reserve the name. Then you or your advisor go, believe it or not, you can do this all online. It makes it a lot easier. I recommend getting an advisor, but some people want to do it themselves, which I understand. You go onto the IRS website and you get yourself a federal EIN, an employer identification number. Basically, the identification number for the company, LLC, partnership, or S corporation, C corporation you're forming. And that now is like your social security number for your company. My S corp has an EIN number. Okay? So first you want to reserve the name. Make sure you have the name. Not everyone does that first, but you want to make sure you name that. You can reserve it for, I think, 30 days. So now you own the name temporarily. Go get the EIN number. As long as you know you're going to do this, get the EIN number. Then you go through the formation process, again, at the Secretary of State level. For New York, you do not do this with the IRS, which is a big common misconception, okay? The cost of this work varies depending on the entity type. Corporation / S corporation, LLC, or partnership. Now, out of all the other types, the one thing that's unique is the LLC formation requires what's called a publication here. Let me see for everyone out here. Has anybody formed an LLC on the group?
Yes.
Okay, so you have. So you've gone through the publication aspect, correct? And who is that saying this?
Mark.
Oh, Mark, okay. So Mark, you formed it and you had to go through the process and pay someone to publish you, correct?
Correct.
So what publication is, and it's really the dumbest thing ever, is Mark had to either do it himself or hire someone to go on and advertise in a local newspaper of some sort and announce the formation of Mark's LLC. Basically, it's a way to raise revenue, more or less. And no one cares. No one ever reads those things. I'm from Long Island myself, so sometimes in Newsday, you would see like pages of this stuff. And that would be the announcement of Mark's S Corporation. But yet, if I formed a partnership or an S Corp, I wouldn't have to do that. So why does an LLC have to do it? A C Corp doesn't have to do it, or a partnership hasn't. I don't know. It was just something they put in the law years ago. And not every state does it anymore. And back years ago, when Bloomberg was still the mayor, he actually tried to get rid of it. He thought it was ridiculous because it can go up to, as you can see on the slide, up to $1,500. That's a lot of out-of-pocket money. And what do you get for it? Bookus. You don't get anything. You just have to do it. It's part of the requirement. I'm sure, Mark, you weren't happy paying, what'd you pay, $800 for it or something like that, Mark?
Whatever they told.
Whatever they told you. I'm sure you were excited to write that check.
Well, I got so many of my friends started calling up and saying, hey, I saw you in the paper.
Okay, all right, keep saying for a minute. Right?
Yeah,
okay.
like crowded, crammed in.
Right, so some people keep it and they frame it, but whatever, you're still paying for something that gives you nothing at the end of the day. So once you go through this process, there's lots of the process, I'm not going to get into all that. You hire someone to go through the process, you cross your T's, dot your I's. Now your entity is formed. Great. Okay, now what do? Now you got to do it. I'm assuming we're all going to do it in New York. You can form it in Delaware or another state, but I do recommend in New York. There's no real reason to form something in Delaware unless you know for sure you're going to be a publicly traded company. Then you go to the Division of Taxation or any other states that are relevant, and you register. You register your business. Okay? Now, The things that a lot of times you're registering, depending on what you're doing, possibly payroll taxes and or sales taxes. So basically, if you're an S corporation, when I formed my company, I had to register online to be able to withhold payroll taxes for myself. Now, I don't sell anything that's taxable. Let's say I was selling, I don't know, wine glasses. I'm selling something that's subject to sales tax. Then I have to register for sales tax, okay? So now you have to register for those things, okay? Go through that registration process. So first you register with the Secretary of State, form the company, then you register with the Division of Taxation. Now it's important, and the reason I bring it up, and this is something a lot of people don't think about when they do it, when you're the owner and the officer of your entity, you have issues with regards to something called trust fund taxes, which are sales taxes and payroll taxes. So let's assume that P. Washington Flowers is an LLC and you have 5 employees and you're selling flowers. So now when you sell those flowers, you got to charge and collect sales tax, and you have to collect taxes, payroll taxes from your employees, right? You're holding that money in trust for the government. In doing that, the state is trusting you to remit those monies. If you don't remit those monies, it's a big deal. A lot of my practice is helping people out who don't properly remit these taxes. And if you keep these trust fund taxes, it's actually a criminal act, it's felonious, and basically you can go to jail for it. A lot of times you see this in bars and restaurants. When they start up, they don't have enough money. They think somehow that money magically that they withhold from, the guy cleaning the dishes in the back, the dishwasher, somehow they think that $100 they withheld from his taxes and the money that they basically collected in sales tax is theirs. That's not the case. Good example, years ago, one of my favorite places in the city was called the Park Avenue Country Club. It was on Park Avenue, and it was a sports bar. It was actually a very nice sports bar. Well, it came out 4 years after they closed the business, leaked out that those guys were not paying sales taxes. One of those guys, I think, went to jail. Big deal. Closed the business. They went in, they padlocked it. A lot of my clients do this. They collect and they don't remit. That's a felony. Big, big deal. So pay trust fund taxes first and yourself last. So if anybody on the call here basically is selling something that's subject to sales tax, you're now collecting it. You got to remit that to the government. If you have payroll taxes, you got to collect it and remit it. Don't keep that money. It is not yours. Pay the trust fund taxes first and yourself last. That little saying will save you a lot of agita. A lot of people do the reverse. Well, I'm working so hard, I'm going to pay myself first. Oh, I don't have enough money, I'm not going to pay the government. Well, the reckoning come down pretty quick, especially on payroll taxes. When those numbers don't add up and your employees, you have to give them a W-2, and the government's waiting for $50,000 of payroll taxes, and you only give them $20,000 because the W-2 doesn't match what your employees have. Welcome to being audited and possibly having some major problems on your hand and being in an orange jumpsuit. Okay? So basically, the important thing here is also, we're going to talk more about this, and then I think maybe we'll take a break. Where do I have to file a tax return, right? So before we get into everyone's business, this is what we'll do in the second half. Is anybody planning, they think their good business is going to span outside of New York State?
No.
No? Anybody?
Yes, possibly.
Okay. Possibly, right. Okay.
Me too, possibly.
You too as well. Okay, great. Kenya, great. So this is important. So back in the old days, and I'm not even that old, the old days were only a few years ago, wherever you were sitting is where you had to basically file a sales tax or income tax return. That's now changed. So again, if you're selling flowers, and you're selling flowers only in New York, and you never leave Long Island, let's say, and you stay there, then you have to file a New York State income tax return, and you have to collect and remit sales taxes in New York. But let's say that you have an online business, right? And your online business sells all over the country. Do I have to pay sales tax there? Do I have to have income tax return filings? The answer is it depends. It's important to know that you don't always have to be located in a state to file a tax return. And that's a big surprise to some people. They think, well, I'm sitting here in basically my basement in Merrick. I've never left, and I'm selling stuff all over the country. But as long as I've never left, I shouldn't have to pay tax in those states. That's not necessarily true anymore. Okay? So basically, this is concept of nexus. Where do I have to file a tax return? So nexus may be a new term to everybody. Nexus is the quality and quantity of business connections that must exist between a political jurisdiction, New York, New Jersey, Connecticut, Maine, California, and a taxpayer, all you folks here, before that jurisdiction can impose a filing requirement for either payroll, sales, or income taxes. Does that make sense? It's a connection, right? As we all know, we're all Americans, I assume, on the call. Everyone's probably lived here at least for a few years. We understand that we have a federal government and we have 51, arguably if you count DC, even though it's not a state, but they tax like a state. 51 or more jurisdictions, right, that also have taxes to some level or another. Florida, Texas, they don't have income taxes, but they have sales taxes, right? So basically you have to figure out where do I file these taxes. We'll talk about income tax first. So income tax is the income you make, whether that's taxable or not for your legal entity. Basically, the nexus standards is something that's been around for a while. Public Law 86-272, the law was passed, I think, in the 50s. Need a physical jurisdiction in a location before a return needs to be filed, more or less. That was the old standard. Own or lease property in the state, employ personnel in the state, or have employees going, let's say, from New York into a new state. So let's say New Jersey, you're always here in New York. I'll use me as an example. If I were to go in to see my clients in New Jersey, which I don't do anymore because no one does in-person meetings, if I was, then arguably if I was going to Jersey a lot, I would have to file an income tax return in New Jersey because now I've been in that jurisdiction. Unless I'm just soliciting tangible personal property under this Public Law 86-272. Let's say I was selling coffee mugs and I was saying, hey, I have the best coffee mugs in the world. Take a look at them, and that's all I'm doing. Then arguably under the law would say, okay, I don't have to actually file a tax return in New Jersey. That's the way the law kind of used to be. Now it's evolving over time, okay? Then things changed a little bit. Then they came up with an income tax economic nexus rule. And that basically says if you cross a certain threshold on the amount of income you sell into a state, you now have to file tax returns. And there are a few jurisdictions that have this. Alabama, California, Colorado, Connecticut, right here in our backyard, Michigan, New York, where we all are. Ohio has a tax called the CAT tax, commercial activity tax, Tennessee and Washington State. Purely financial standard, no solicitation, don't have to go into the state. They can, otherwise you're not doing business in the state, but if you cross over a certain financial threshold, voila, you have to file a tax return then. Does that make sense to everybody? It's not fair, but it is a current state of the law, okay? So basically once you cross over, generally some states, 150,000, some are 250, some are 500. You cross a certain threshold, arguably you have to file an income tax return there. So as you're forming your business and your business grows, talk to your tax advisor and say, hey, I remember this guy talked at Hofstra something about income tax nexus and nexus standards. I'm selling in 15 jurisdictions. Do I have to file income tax returns in those jurisdictions? Talk to them, make sure you're doing it. One thing that's important, let's say you don't ask that question for 10 years. And one day you Google it and you're like, oh my God, I should have been filing California. You don't want to just out of the blue start filing tax returns. You basically want to contact someone and say, hey, I probably should have been filing tax returns for these years. How can we solve the problem? And you do things called voluntary disclosure agreements and things like that. If you just throw in a tax return, then all the back years are open and they can audit you, hit you with penalties and interest, and it's not pretty. And again, all the money you would be paying would coming out of your pocket and you'd get nothing for it, okay? So that's income tax. So now there's sales tax. Under the old law, dating back 1992, case said quill, and basically said you need some type of connection to a state. Some type of physical presence, employees in the state, property in the state, employees soliciting any type of business, or sending anybody an independent contractor working in a state, right? So let's say I was selling coffee cups again. I sent someone to New Jersey who was an independent contractor for me. I then would now have nexus to New Jersey, even though I never left New York, okay? That's the old standard. Then economic nexus came in, okay? And they basically, that was gross receipts and income taxes, and now sales tax economic nexus. And okay, if you have over $100,000, arguably, you're going to have nexus as well. And that evolved, and we'll talk about that in a minute. Then you had something called Amazon or click-through nexus. Has anybody ever heard of this before? Yes?
No.
Okay. No? Okay. So this was the law before the new law dropped 2 years ago. And that basically said, let's say I advertised my legal services on a website for a company based in in Colorado. And let's say legal services were taxable in Colorado, which they're not for most sales tax for most states. Let's say it is. If I paid the Colorado company that I advertised in their website, and we had a financial relationship, I have a contractual relationship with them, I would have an agency relationship. Colorado could say, under, let's say, their Amazon law, click-through nexus, because of that agency, now I have a connection to Colorado. So any business I do with Colorado companies, I now have to collect and remit sales tax. That was very aggressive. And believe it or not, that started right here because of Amazon. As everyone probably recalls, probably 3 years ago, if you bought anything on Amazon in New York, you didn't pay sales tax, right? They just shipped it to you. Now, you were supposed to remit what's called use tax on your personal tax return, but no one ever did that. New York passed a law. People call it the Amazon law. Basically, that went up the chain of command and basically said no one is going to deal with this. And basically, it kind of softly became the law because it didn't get through the Supreme Court. Then things changed. Okay, and that's what we talked about here. Then the new standard came out. Pure financial standard called Wayfair. Has anybody heard of this case by any chance?
No.
And the only reason why I say this is it was on the front of all the major newspapers, the Wall Street Journal, the New York Times, even some non-business newspapers. Basically what comes out is from South Dakota, apologize. Law comes out and says, if you have over 200 sales into South Dakota or $100,000 of sales, even if you never leave your basement, sitting out in Merrick and you're selling coffee cups, we don't care. You now have nexus in South Dakota. Case went all the way up to the Supreme Court, and the Supreme Court said, you know what? Times have changed. The internet changed the game. Now, that's right. If you have selling into our state with over 200 transactions or $100,000, then voila, you now have a sales tax collection, filing and remittance responsibility to South Dakota. And you're probably thinking, well, why is that a big deal? Well, because now that opens the door to over 40 states doing the same thing. Most states basically say the same thing. Over $100,000 or 200 transactions, voila, you now have sales tax. That's a huge game changer. For the people on the call who have a business that are going to be selling outside of New York, you want to monitor that. I don't recommend registering for any states in which you have a small amount of sales. But once you start to creep up in sales, you'll kind of want to monitor. Some states are different than others. Some states once you cross the threshold, that everything is taxable. Other states say only when you cross the threshold. So let's say Alabama, the threshold is 150. Alabama could say, once you cross over 150,000, then that first sale after 150 is subject to sales tax. Other states say no, once you cross the threshold, it all becomes taxable. So you do want to talk to your tax advisor and basically see which is the case in any jurisdiction you're selling into. Okay? Does that make sense? Yes.
Yeah. So they actually set that up because there's really no balance if you depending on your product. Like at $500 a sale is what it takes to get to $100,000 at 200. So if you're selling mugs, you got $3,500 worth of mugs, and that 200 sales initiates the thing rather than the 100,000. They didn't do it whichever's higher.
It's generally either or. Most states. I didn't go into every state because obviously we never get.
No, that's a huge difference depending on what your product is.
100%. But their feeling is not to defend them. I'm just telling you what their mindset is, because I'm very against this decision, by the way, because it's kind of it's apolitical. I understand both sides of it, and I'll answer your question. My feeling is always I should be getting something for my money. So right now, if I sell it to Alabama and my clients don't pay me in Alabama, I don't really have any recourse in the Alabama court. So I'm not getting anything for my money because I've never been to Alabama, right? So that's why I don't like the decision. But yes, it's very arbitrary. And let's say I sell things that are worth 10 cents, right? So now is that fair? I have 200 transactions at 10 cents, that's $20, right? But someone else goes right up to the line right, 99,900, and they don't have nexus, and they have same amount of they have 199 transactions, but they don't cross over. Meanwhile, I have 220 transactions, and I have $22. Most states are either or. Some it's higher of, right, in the benefit of the taxpayer. So you really have to look at that. And when I started my career, I was state and local tax called SALT. And the old joke with, you go up to the SALT guy sitting in his cube or office, you ask him a question, what's the state rules in these 5 states? My answer was, it depends. That's the case here. The rule in Georgia is probably different than Alabama, probably different than Nevada, then different than Wisconsin. So you kind of have to look at that. So just know the thing you take away from this is we talked about entity choice, but then the natural progression, which I used to not always talk about nexus here, is when you're doing business in these states, where do I have to file? Always keep that in mind. You choose your entity, now your business is running, you know how your tax is kind of going to go a little bit. Now I have to deal with these other states besides the federal government. Do I have a footprint in these other jurisdictions? And that's important because, again, if you don't collect these taxes from a sales tax perspective, and let's say you're going to notice from Georgia, they're like, oh, congratulations, Mark, we found that up at your company. This is great. Because they did an audit of a Georgia company, and they saw your name, and they audit you, and you didn't collect the tax. Guess who's going to pay the tax? Your company does, which really is coming out of your pocket because you are a sole owner of an LLC or an S Corp, or you have a partner. That money, good luck going back to your client and getting those tax dollars. That's not an easy thing to do. Does that make sense?
The other reason I was saying it though was it just if you've got $3,200 worth of sales, the amount of time it takes you to report,
yes,
and do that is like, don't do it.
100%. And that's a business decision you have to make. That's why if you know your business is going to grow and you're selling outside of New York, for the gentleman who said it before, I'm assuming he may be online or he may be going to other jurisdictions. A lot of times my clients will call me up and they'll say, listen, I may have a client up in Connecticut, let's say, but I know I could have Nexus up there and it's going to be a considerable client, but it's a one-off, meaning I'm only doing it once. That's it. I'm going up there. Let's say I'm a physical therapist. I'm going up there and I'm going to be going up there 6 months. I'm going to make 50 grand. What do you think I should do? And I'll say, okay, well, technically you're going to have income tax nexus. And if you give them, let's say, exercise stuff, you probably have sales tax. You're going to have sales tax nexus and collection as well. You have to decide whether you want to register. Under the law, you should register. Whether you want to register or not, that's your business. And you tell me if you want my assistance. But at least you're armed with knowledge. And some people go in states, they go in and get their money and they say, I'll sleep fine at night. I don't want to register. I don't want to do it. Other people are like, no, we're going to do a lot of money and do a lot of business in Connecticut. I had a tech company, IT firm. They've been doing business in New Jersey for 3 years. They just got a big contract. They hadn't signed yet. They hired me. I did a voluntary disclosure for income and sales tax. I just closed the case. We ended up paying New Jersey $20,000 for the past 3 years that we never did, but they just landed $1 million contract. So for them, it was worth it. And they didn't want to get audited. And they were afraid they would get caught with penalties and interest. So we came forward voluntarily because they knew their business was growing. They have clients in other states, but they're like, we don't care. Those were one-offs. New Jersey is our next foray. They're actually going to open an office there in a few years. This was, of course, before the pandemic hit. But point being, you have to do that balancing act. Sometimes I have clients who are like, you know what? I don't want to do business in California because they're so aggressive. I'll pass because it's a one-off and it's not worth it to me. Make sense, everybody?